This Friday, a South Korean company you may never have heard of pulled off the largest foreign IPO in American history. Hynix sold shares on the Nasdaq and raised roughly $26.5 billion, second only to the biggest U.S. listings ever. The offering was reportedly more than 7 times oversubscribed, drawing demand from over 500 investment firms, and the stock opened about 14% above its price. But the real story is not the size of the check. It is who wrote it, and why. Hynix makes memory chips, the least glamorous corner of the semiconductor world. A decade ago, the company was fighting near collapse. Today it is worth roughly $1 trillion. Understanding how it got here explains almost everything about the AI boom. Every AI accelerator needs a special kind of memory called high bandwidth memory, or HBM onshore. It is the component that feeds data to Nvidia's chips fast enough to train models. And Hynix is the world's dominant supplier, holding roughly half the HBM market and the majority of Nvidia's next-generation orders. That is the mechanism behind the whole listing. When AI spending exploded, demand for HBM exploded with it. And Hynix found itself sitting on a near monopoly in the one part that the boom cannot function without. The company has said its entire 2026 output of HBM, DRAM, and NAND is already sold out, with the crunch expected to stretch into 2027. In other words, the IPO is not a bet on the future. It is a way for American investors to finally buy a piece of a shortage that already exists. So why cross the ocean to list at all? Because of something investors call the Korea discount. For years, South Korean companies have traded at strikingly low valuations, partly over worries about opaque conglomerate structures and governance. The gap is almost hard to believe. Hynix reportedly trades at under 5 times forward earnings, against an industry median approaching 30. Even US rival Micron trades higher. Analysts say the difference is mostly access and familiarity. American funds simply could not easily own the stock, so its price stayed depressed despite its commanding lead in AI memory. The Nasdaq listing is an attempt to fix that with plumbing rather than performance. By parking shares in the world's deepest pool of capital, Hynix is betting that access alone can re-rate a business the market has quietly underpriced for a decade. The $26 billion is not going to shareholders. It is going into concrete and machines. Hynix has said the proceeds will fund a new memory fab being built now in South Korea to attack the AI-driven shortage, a new advanced packaging facility, and a fresh order of UV scanners. The extraordinarily expensive machines that make next-generation chips possible. This is where the AI boom stops being abstract. All that capital is colliding with a hard industrial limit. Fabs take years to build, and UV tools have long waiting lists. That is the quiet reason US officials are reportedly urging the company to build fabs on American soil. The memory shortage is not just a pricing story. It is a geography question about who physically owns the machines that make the chips the whole economy now depends on. Here is what most of the coverage is missing. This record IPO and your rising phone bill are the same story. To feed AI data centers, the 3 companies that control almost all of the world's DRAM have reportedly shifted capacity toward HBM, leaving ordinary memory scarce. DRAM prices have roughly doubled since early last year, and analysts estimate PC prices could rise around 17% and smartphone prices around 13% versus 2025. With shipments expected to fall. Data centers now consume an estimated 70% of memory produced worldwide. So the real thesis is this. Hynix's triumph is a transfer of resources from consumer devices to AI infrastructure, and everyone who buys a laptop is helping pay for it. The applause on Wall Street and the sticker shock at the electronics store are 2 ends of one supply chain. Watch this space, because that squeeze is expected to run into 2027.